Hello and welcome to this session. In today's session, you will learn about equity, commodity, and FX swaps. In this session, you will learn about the features, key terms, and uses of equity swaps, commodity swaps, and foreign exchange swaps. Let us begin with equity swaps. An equity swap is a financial derivative contract where a set of future cash flows are agreed to be exchanged between two counterparties at fixed dates in future. Equity swaps are used to substitute for a direct transaction in stock. An equity swap involves a notional principal amount, a specified duration, and predetermined payment intervals. The two cash flows are usually referred to as legs of the swap. As with interest rate swaps, the difference in the payment streams is netted. One of these legs is usually pegged to a floating rate such as LIBOR. This leg is also commonly referred to as floating leg. The other leg of a swap is based on the performance of either a share of stock or a stock market index. This leg is commonly referred to as the equity leg. Most equity swaps involve a floating leg versus an equity leg, although some exist with two equity legs. One leg of the cash flow is calculated based on return on equity or an index. The other leg of the swap is based on interest rate, be it fixed or floating in some cases, an equity stock or index itself. There is no exchange of notional between the counterparty here as well. Here we have some of the important terms used in Book of a Client. The trade date is 1st April 2015. The effective date is 1st April 2015. The reset frequency is semi-annual. The reset date is 1st October and 1st April everywhere. The payment date is 1st October and 1st April everywhere. The termination date is 1st April 2020. The term is 5 years while the currency is in euro. The notional amount is 100 billion euros. The direction is client A sells, client B buys. Here the counterparty is client B. The equity underlier is Nasdaq 100 at the rate of 4085 euros on effective date. The interest rate is fixed at 3%. The spread is not applicable in this case and the day count convention is to be followed as A by 360. Moving on to speculation of an equity swap application. When client A is bullish on interest rate of a country and bearish on stock market index performance, and client B is bullish on stock market index performance and bearish on the interest rates of country, they can enter into an equity swap. Typically, equity swaps are entered into to avoid transaction cost including tax, to avoid local based dividend taxes and limitations on leverage, notably the US margin regime, or to get around rules governing the particular type of investment that an institution can hold. Equity swaps, if effectively used, can reduce investment barriers and can help an investor create leverage similar to those seen in other derivative products. Next, we move on to commodity swaps. A commodity swap is an agreement where the floating or spot price, which is also known as market price, is based on an underlying commodity, is traded for a fixed price over a specified period. A commodity swap is similar to a fixed floating interest rate swap but with one major difference. In a fixed to floating interest rate swap, the floating leg is dependent on market rates such as LIBOR, but in commodity swap, the floating leg is based on price of an underlying commodity like sugar, oil, etc. There are two types of commodity swaps, fixed to floating and commodity for interest. Fixed to floating commodity swaps are just like the fixed floating interest rate swaps in the interest rate swap market, but they involve commodity based indices. General market indices in the commodities market like Goldman Sachs Commodity Index, also known as GSCI, and Commodities Research Board Index or CRB plays different ways on various commodities. So they'll be used according to the swap agent's requirement. Commodity for interest swaps are similar to an equity swap in that a total return, the commodity in question, is exchanged for some money market rate plus minus a spread. So why do we need commodity swaps? The commodity producers must manage and limit their exposure to fluctuations in the prices for their products. They are primarily concerned with fixed prices on contracts to sell their commodities. For example, a gold producer will want to hedge losses related to the fallen price of gold for his current inventory, while a cattle farmer will seek to hedge his exposure to changes in the price of the livestock. Next we have end user, that is those who deal in commodities need to hedge prices at which they can purchase these commodities. For example, an airline will need to lock the price of jet fuel it needs to purchase in order to satisfy the peak in season demand for travel. Finally, you have speculators. The speculators are funds or individual investors who can either buy or sell commodities by participating in the global commodities market. Considering the example of jet fuel, many may argue that their involvement is fundamentally destabilizing. It's liquidity they provide in normal market that facilitates the business of producer and of the end user. Moving on to the evaluation of a commodity swap. Let's say an industrial producer, BP Inc., needs to buy 2 lakh barrels of oil for next 2 consecutive years. The forward prices for deliver in 1 year is $25 a barrel and 2 year is $30 a barrel. And the 1 and 2 year zero coupon bond yields are 7% and 7.5% respectively. In pricing a commodity swap, it is helpful to think of the swap as strip of forward contract, each priced at inception with zero market value. Thinking of a swap as strip of at the money forwards is also a useful and intuitive way of interpreting interest rate swap or equity swaps. BP Inc. can guarantee the cost of buying oil for next 2 years by entering into long forward contracts of 1 lakh barrels in each of 2 years. The present value of per barrel cost would be $25 divided by 1.07 plus $30 divided by the square of 1.075, which equals to $49.31. Thus BP could pay an oil supplier $49.31 and supplier would commit to delivering 1 barrel in each of the next 2 years. A prepaid swap is a single payment today for multiple deliveries of oil in future. In this case, BP can confirm that they are ready to buy oil for next 2 years. As a hedging strategy, they will get into an agreement with the oil producer by buying a forward contract. Based on the present value, per barrel would be $49.31. With a prepaid swap, the buyer might worry about the resulting credit risk. Therefore, a better solution is to defer payments until the oil is delivered while still fixing the total price. Any payment stream with a PV of $49.31 is acceptable. Typically, a swap will call for equal payments in each year. For example, the payment per year per barrel X will have to be $28.49 to satisfy the equation. We then say that the 2-year swap price is $28.49. Now, if all payments are made in the first year itself, the BP is exposed to credit risk. Hence, they will enter into commodity swap, which will be taken by making a payment of $28.49. Finally, a brief primer on foreign exchange or FX swaps. Let us begin with basics first. A foreign exchange is exchange of one currency for another at an agreed exchange rate. Consider you are an Indian investor in Euro region, starting with FX buy. It refers to buying a foreign currency along with selling of a domestic currency. That is, you buy euros and sell INR, Indian rupees. FX sell refers to selling of foreign currency along with buying of domestic currency. That means you sell euros and buy Indian rupees. And lastly, a cross deal refers to buying of foreign currency along with selling of a foreign currency. This can be used if you buy US dollars and sell euros. A foreign exchange swap is simultaneous purchase and sale of one currency for another with two different value dates. An FX swap allows some of certain currency to be used to fund charges designated in another currency without acquiring foreign exchange risk. It permits companies that have funds in different currencies to manage them very efficiently. This is done by entering into two different contracts. In leg 1, you can buy or sell, or term or spot and forward. In leg 2, you can sell or buy in term or spot and forward. In fact, leg 2 is reversal of leg 1 FX trade but with a different exchange rate. In leg 1, effectively each party is given the use of an amount of foreign currency for a specific time. In leg 2, each party is taking a view on relative movements of currencies in interest rate between two dates in comparison with their relative current prices. Effectively, an FX swap is two exchange contract packed in one, a spot foreign exchange transaction and a forward foreign exchange transaction. The most common use of FX swap is for institutions to fund their foreign exchange balances. A foreign exchange swap will often be used when a trader or hedger needs to roll an existing open foreign position forward to a future date to avoid or delay the delivery required on contract. Nevertheless, a forex swap can also be employed to bring the delivery date closer. As an example, foreign exchange traders will often execute rollovers, more technically known as term or neck swaps, to extend the value date of what formerly a spot position entered into one day earlier to the current spot value date. On the other hand, a corporation might wish to use a foreign exchange swap for hedging purposes if they found that an anticipated currency cash flow, which had already been protected with a forward outright contract, was actually going to be delayed for one additional month. In this case, they could simply roll their existing forward outright contract hedge out 1 month. They would do this by agreeing to a foreign exchange swap in which they closed out the existing near date contract and then opened a new one for the desired date 1 month further out. An FX swap is a mix of any of the following: spot and forward, cash and forward, spot and term, where term is short for tomorrow. Here the trade that happened today but settled tomorrow is called term. Cash and term and forward, or cash and spot. Both the legs of the swap have to be agreed at the same time. That is, the trade date of two legs have to be the same. The main aim of an FX swap is to manage the funding of currencies across various business units to identify excess versus shortfall in bank account. This can be made good by entering into an FX swap transaction. Let us take an example of FX trade. While funding or projecting the cash flows for the next few years, there seems to be an excess of USD and shortfall of Euro for 15th April 2014 and vice versa on 16th April 2014. The FX traders can hence agree to an FX swap where they will trade on 15 April 2014. They will buy Euro and sell USD on cash lag with a settlement date of 15 April 2014. They will send Euro and buy USD on term leg with a settlement date of 16 April 2014. The exchange rate used in forward or swaps is known as forward exchange rate. It is derived from spot exchange rate by factoring in short-term interest rate of both the currencies. The risks involved in FX swaps are similar to a characteristic of a forward contract. Let's begin with credit risk. If one of the counterparties default on its obligation, the other party has to sign a new contract, thereby increasing its exposure to market interest rate fluctuations. Next, you have exchange rate risk. By fixing the exchange rate at which the currency will be brought, the party foregoes the opportunity of profiting from a favorable exchange rate movement. Additionally, unfavorable exchange rate movements may take away further profit opportunity for the party in face of opportunity cost. Finally, you have interest rate risk. Since the price of the forward contract is dependent on the differential between the risk interest rates that can be earned with two different currencies, variation in those interest rates can change the price of a forward contract and thus also change the terms of swap. The change can be favorable as well as unfavorable to each party. This brings us to the end of FX swaps. That's it for now. Thank you.